chapter 12 and 13 handout. I think we should finish it. And I'll send out the exam later. It'll be out tomorrow, actually. But well, let's go ahead and do the fast and fun footwear. This fast and fun footwear actually comes from I used to be a certified fraud examiner, and this was on the certified fraud examiner. They have stuff like this on there. But I got to stop sharing my screen, open up fast fun footwear. Okay, and now I gotta share it again. Oh, yeah, I found out how to do it. Maybe not. All right. So this is a fast fun footwear. One of the unfortunate things that happens, especially if you're in well, if you're in auditing, but also especially if you're in internal auditing or something like that, is anytime something bad happens, something is stolen, something like that, a lot of times they call on you to come and see what happened and see if you can figure out, if someone stole something or got lost or who did it and all that kind of stuff. So that's what this is kind of based on. This is this past fun footwear, and all the stuff in here is based on what they do for the certified fraud examiner exam, which by the way you can take. It's actually one of the more reasonable certifications, and it's well recognized. So you can actually take it in college if you want. I want to say it's like $300 for everything. It might be a little bit more now, but I'll say how many. None of them have been sold, but they're all missing. So, so go ahead if you're playing along at home, go ahead and put it in the chat. You can private me if you want. You don't want other people seeing it, but just make your choice. Maybe you pick A, salesperson A, B, or customers. And by the way, there is no right or wrong answer. From the information we can't tell exactly who did it. Anyone else want to chime in? Out in the classroom, what do you guys think?
Yeah, we just Anita made a very strong claim. And I want to thank.
What's that?
I got it okay. Purely unstinking trying to open something, but it's really working. As if the state was like, besides, they also have a pair of those shoes. Why would they take them? And the assumption behind that is, as here, most of the people were unsure if the shoes had been put on the thought of how do you know you already want to wear those shoes? And you don't even know what shoes they were on.
Yeah, that's a very good point. Those of you on Zoom that salesperson B, actually salesperson B is probably the most likely. Salesperson B, said that I already have a pair of those. Well, which indicates two things. First of all, she knew about the shipment, and secondly, that she likes those shoes. or he likes those shoes or whatever it is. So there's there's that. And whenever somebody offers information that is unknown by anyone else, it's also kind of raises a red flag. And she also said earlier, my sales were all shoes from the front of the store. A customer probably they didn't know whether they apparently that they were whether they were on the floor or not. It was the original assumption that neither of them knew. However, she seems to indicate that they were in the back of the store, and that her register tape will show that she was at the front of the store the whole time. It's also very. Let's go to salesperson A. Well, actually, let's go to customers. Customers probably the first one. It'd be very unusual for a customer to walk out with a whole shipment of shoes. They might steal one. They might, one pair or something like that. That would certainly fit the profile of a customer theft. But for a customer to walk out with a whole shipment of shoes it could happen, but it's probably less likely. And also, just in general, employees are more likely to steal than customers in general. It's several times more likely, companies lose several times more to their employees because they have opportunity and they have knowledge. So a lot of times employees are the ones that are, if there's a large theft anyways, that they are the ones that are, I don't want to say always the suspect, but they're certainly one of those that you want to pay attention to. Okay, salesperson A, are you kidding me? Blah, 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 you're nuts, I hate you, whatever. Anger is when someone's accused of doing something they didn't do, anger is a natural. If someone comes up to you and says, hey, you committed this crime and you did, no, I didn't. Get out of here, idiot. It's a natural thing when someone accuses you of something, or indicates that maybe you are that's a normal response. It is sort of unusual for someone to have an alibi ready to go. Most people say, well, what were you doing? I don't know, I was working. Selling shoes, or so to have a lot of information. And here's another part of that. Also, people will often try to get somebody, try to give an alternate scenario so that hopefully someone will grab it. A customer probably took the shoes while we were busy with other customers. That's offering and one of the words there that is key is they'll often use vague terms, because if they ever get caught in some kind of a in a lie or something like that, they'll say, well, I didn't say it was, I said it probably was, I didn't know. They use vague terms, could have, maybe, sometimes, those kind of things are often used for just to try to get people to look somewhere else for the for someone who's guilty. But in this case, now again, we have no idea. It could be salesperson A, it could have been a customer, it could have been, you don't know exactly. But whenever someone offers more information than anyone else has, and especially when someone has a built-in alibi, it's curious. And when they use vague terms, maybe it could have been, that sort of thing. So yeah. And again, we have no idea based on what is there, but certainly you certainly want to be interested in that. Okay, now which of the following is a characteristic of a fraudster? By the way, fraudster is the coolest word ever. Bet it means something bad, because I'd like to be a fraudster. But anyway, which of the following characteristics of a fraudster? So in a company, which kind of people are going to be fraudsters? Someone who's highly respected?
Yeah.
Well, we don't, we're not gonna say a specific person. We're not gonna name you. By the way, and by the way, these are characters that are fraudsters. These are not characteristics that mean somebody is a fraudster. Yeah, so the idea though is that these are qualities that they'll often have. And they usually are highly respected. Committed a violent crime in the past. Nope, they generally don't. Committed a fraud crime in the past. Yes. Recidivism of fraud is, I think only like sex offenders have a worse recidivism. It's very common for someone to get out for fraud and just start up again. This is the way it is. Highly religious. This is an odd one. Yes. Now, that doesn't mean someone who's highly religious is a fraudster. Again, it just means that that is one of those characteristics. A young person, they can be, but generally not. Middle-aged? Yep. New employee? Nope. Long-time employee? Yes. Friendly? Yes. Extroverts? Yes. Punctual? Yes. College educated? Yes. And best employee? Yes. In essence, they look like me. Yeah, but this is one of those things. So people say, well, how do you, how can we stop this? How can we keep this from ever happening again? It's very difficult. Your best employees are going to be the ones that are most likely to do it. And having been in internal audit, I can tell you that that is absolutely the case. I think I told you guys that I had a couple of fraud cases for expense reports and they were the two best people in their department, far and away that did it. There was another very big one that we had was I think I told you guys this one doing the cash thing is that the woman had worked for like I don't know, it was crazy. She worked at the company for like 45 years or something like that, and uh, she was committing a fraud going back decades. Most loved person in the whole company. People just stop in to say hi to her. And yet for years. So it's very difficult to pin down these people. Now, one of the things though is that's very important though is this committed fraud in the past. This is why bonding is such an important aspect. A bonding company will check someone's background to see if they have anything in their background that would cause them not to be able to bond that person. Because anyone who's committed a fraud in the past, the likelihood is very high that they're going to do it again. It's in the 90% level somewhere. So whenever there is a crime that was committed in the past, especially a fraud crime, it becomes it becomes someone who's a very highly suspect of doing it again. Okay, we can turn that one in. And again, this one, there's no right or wrong answer. And again, on these other ones, or even on this page, it doesn't mean if you're a good employee that you're committing a fraud. It doesn't go both ways. It's just that is a characteristic that many times will have, that someone who commits fraud will have. Okay. Save that. And we will go into oh, yep, okay. Uh, okay. Inventory. I'm doing inventory and property, plant, and equipment together. And the reason is they in some ways they kind of go together. They are both assets and they're usually tangible. You know, inventory is usually tangible and also the assets are usually tangible. So a lot of the stuff that we do is the same for both of them. Not, I mean, not completely, but a lot of it is. Okay. First of all, controls over inventory. You must obtain an understanding of the internal controls. You do not need to test, you don't need to test them unless you're going to rely on them, but you must get an understanding. That's for every account. That's not just for inventory, that's everything. Okay, periodic inventory is done at the end of the period. For example, so periodically, so December 31st, we all get together and we all sit and not sit, we all walk around and do the inventory, and we get a solid number for our inventory at December 31st, 2025. Done at the end of the period. And our accounting system is usually set up for that also. It can be a perpetual system that also does inventory at the end of the season, at the end of the period, but oftentimes it's not. They go together. The periodic we'll go with the periodic accounting system. You can take inventory whenever you want, no matter what, how you're accounting for it. Perpetual inventory system. They're perpetually updated. Updated for any sale, purchase. And returns. So it's updated continually. And this is what many stores have, especially nowadays. If you're scanning anything, if you're scanning stuff at a register, it's a perpetual system. When you go to the grocery store and you buy a gallon of milk for $3, they'll scan it and it'll somewhere in the system, it'll say, okay, we no longer have 342 gallons of milk. We now have 341 gallons of milk. And then when it gets down to 200, it probably says, okay, we need to order more milk. It's a perpetual system. They know exactly, when you scan it, they'll have a cost assigned to it, and it will automatically update the inventory to say, look, we have one less, or however many milks you buy less. Oftentimes, perpetual inventory will have continuous inventory counts throughout the year. And I think I mentioned this before. Someone like Walmart, it would be completely impossible for Walmart to do a year-end inventory. There's not enough auditors in the world go to all the stores to check all the sales that are done up until, the midnight. I think they're at the end of January. I think they're year end. Most retailers are. But on January 31st or whenever their year end is, they have all the auditors, go there and to make sure the shipment's coming in and the sales going out for every store. It would be impossible. Now, you say, okay, well, so what do you do? Well, if you're an auditor, you'll have those interim counts of inventory. And yeah, you'll go to the if you ever like in a 24-hour Walmart or something like that, if you go in late, you'll see like they'll actually have aisles and they'll say, they'll have all these tags on it and they'll say, and sometimes they'll have ones that say do not inventory this, and they have all this stuff up. And that's for people that come in at 2 in the morning and will do that inventory. They'll do that round of inventory, they'll check it, they'll get all the SKU numbers, the SKU. I think it was called stock keeper or something. I don't know. It's some 100-year-old term. But anyway, the SKU numbers, you hear about the SKU numbers, SKU numbers, that's what they're doing. They're counting them, looking at the SKU numbers and doing their inventory. And they'll do it throughout the year. And there's nothing wrong with that. Everything in the inventory must be counted at least once during the year. But when they do it is it could be almost any time throughout the year. And again, they'll tell you, and if you're doing it, and we'll say, when can we observe it? And you'll go and you'll observe it just like you'd observe your year-end inventory. Okay. Obtain a listing of inventory and reconcile it to the ledger. So the inventory list and the ledgers. And the ledgers could be, especially the general ledger, but there could be specialized ledgers too. This is usually a fairly easy one to do. And I may have already told you this one also, but I was on an audit that they didn't match. They weren't off by that much, but they didn't match. And as it turned out, there was a purchasing guy that was negotiating prices, and one of the things that he would do is negotiate prices going backwards. So he would say, well, we bought so many of these from you last time, and we should have, you should have gave us the same discount we had last or whatever. And they would go, okay, whatever. And they would give in. And then he would insist that the inventory be changed. Now, notice this is inventory that's already been purchased. Oftentimes it was already used and is no longer there. It's already been paid for, and yet he was negotiating new prices on it. And he was very upset with the accounting people, so he usually made him go and change the books. What he could have done, what we told him, he should do. What I suggested and what other people suggested way before me, okay, just put it in as a line item, a rebate or whatever you want to call it from the vendor. But he got really upset about it, and so they just anyway. During our audit, at some point, he actually left the place, but it had nothing to do with our audit. Absolutely nothing to do with it. Produce a character. We said, well, why didn't they just put a gain or a loss through, and he just exploded. That's not it. The cost of the, okay. All right. I like in inventory selecting dates, especially if you have a date. You can do it if it's not at year end, if they have controls in place that are good enough that you can work backwards to make sure that the inventory is correct. So for instance, let's say, like for instance, 12/31, New Year's Eve. It's really hard to get people to want to do inventory on New Year's Eve. So, maybe they do inventory the day before, and as long as there's, the controls are in place, or maybe they're not taking shipments on that day and making sales, you can do it on different dates. But suspending production in certain departments. I worked at a place that we couldn't do that. That was US Steel. You cannot shut down a steel plant. Costs tens of millions of dollars to get it back up and running. Oop. Okay. Couple things. Segregating obsolete or defective goods, and we'll talk about this in a little bit. One of the things that you should make sure that they are doing is segregating those things that are special, that are going to have special considerations, and obsolete and defective inventory are one of those things that they need to separate out, so that 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 they are not going to be like the other ones, basically. Okay, establishing count through the use of inventory tags or sheets. This is any of you guys on inventory? Anyone on Zoom done inventory? It's actually kind of interesting. If you go into a store, what they'll do is they'll have these tags usually, and the tags are numbered, and the tags are numbered sequentially. They're not just random, sequentially. So, for instance, if there's 231 tags, they have to account for all 231 tags. Someone will go around and put those tags on all the inventory that needs to be counted. So you'll see like a coat rack, and it'll have a tag on it or a sheet on it, same thing. And whoever does that inventory will either take the sheet and fill it out, or take the tag and attach it to a sheet to fill it out for what the inventory is there. And they'll look through and they'll count up the SKU numbers and the quantity, and all that will go into the inventory. So the use of inventory tags or sheets are used to make sure the inventory is properly counted. Where was it? Yeah. Pre-arranging for the services of engineers or other specialists. Gemologists are often talked about. If you're auditing a store that has jewelry, you have a gemologist come in, and if I look at a diamond ring, I have no idea what it's worth. So sometimes you have to have someone come in. One of the biggest ones you'll have for larger companies is you'll have actuaries come in for things like the pensions and the healthcare and all that kind of stuff. And it's very common to have those actuaries come in. And it's also one of the weird ones in that you can actually use the exact people that are working on the pension. You can use them as your specialist. And there's a good reason for that. They're going to be the ones that are actually going to know exactly how those numbers came about, and they'll explain those to you. Okay, proper cutoff. We talked about this. What documents would be used to verify the following cutoff? Purchases and sales. The sales one we already did. I don't think well, yeah, the purchases one's a little bit tricky. I think we may have talked about it, but I don't think we actually. How do we verify sales? Well, actually, it's on the accounts receivable exam. 'Cause, 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 'cause,
Sales invoice,
What was it?
sales invoice.
Sales invoice will get you partway there. By itself, the sales invoice isn't really worth it. But what do we look at to make sure that this thing is actually sold? Start with a B,
Okay.
bill of lading. So sales, often you'll look at the bill of lading, and even more than the proof of delivery, because the bill of lading shows that they actually shipped something out. So you look at the bill of lading and see if that is, when they're actually dated. Yeah,
I think it comes when that, cases like shipment, what of sales in a sense of like, you know, in-house sales or the customer sales.
yeah. At the end of the day, they should have something in there to account for those at the end of the day. If you have talking about a place that's open 24 hours, yeah, it is more difficult. And, you want to make sure that the sales are cut off at, say, midnight, but it can be a little bit tricky. Someone's saying in the register, you're ringing things up and it's midnight. But yeah, so if something that's shipped, you're going to have the shipping documents. Something that's not shipped, it's going to be, usually it's when the register is actually rung it up, is when it counts as a sale. But yeah, and we talked about this, I think, too. You remember that, the sale, it affects a lot of things. If you have a sale, it could very well affect your accounts receivable if it's not a cash sale. It could also affect your inventory, because anything that's on that sale will be reported as, the inventory will be gone. It shouldn't be in your inventory. If it's not actually gone, it might, as a very, it's very problematic that it might get counted as being in inventory. So not only are the sales going to be overstated, also your assets are going to be overstated because of the inventory. Purchase cutoffs. I don't know that we talked about this one too much. I can't remember, to be honest with you. This is usually done by receiving reports. I don't think we did this. Receiving reports. The receiving department will have receiving reports. And the receiving report should be dated, obviously, when they actually receive the goods. So if they receive the goods on, December 20 or 31st or whatever, that they're counted as being received, and that's part of your inventory. One of the things you'll also do is check for unmatched receiving reports. Unmatched receiving reports are receiving reports that are not matched up to a purchase order. And one of the things as an auditor you need to do is find out why. Why did somebody send something to us without a purchase order or without an invoice accompanying it? So receiving reports that are not matched up is also something that you need to investigate, because that very well could be that there's inventory in stock that is not on the books. And again, the problem with that is, stop sharing. Oh, do I have a marker? Maybe I do. You just mark one. It's really. This is, where am I at here? Okay. When you're looking for, say, your cost of goods sold, you have your beginning inventory. I'm making these numbers up. And you'll have your purchases. And this will give you your available. Now, to get our cost of goods sold, they'll subtract out the ending inventory. So notice if there's not something on the books for that invoice that came in, the receiving report or something that came in, but that stuff ended up in inventory, it's going to inflate that ending inventory number, which will decrease your cost of goods sold. In other words, it'll make you look more profitable than you really are, and it'll overstate your inventory. So for ending inventory, let's say that it should be, I don't know, give me a number, something around 5,000, 8,000. So if this would be your, if you have this much available, there's this much ending inventory. In other words, this was not sold. Ending inventory was not sold, so what was sold would be the rest of it. Uh, 19,000. So that'll be subtracted from your sales. Again, I'm just making these numbers up. You don't have. I'm going to be profitable. Let's say something over 19,000, 30,000. Okay, so 30,000 came in, and that was for things that cost us 19,000. Now, if there's extra things in this inventory, what's going to happen is the inventory is going to be overstated, but also your income is going to be overstated because your gross margin or gross profit, same thing. You can see this. For instance, this is 11,000. That is. Hey, I got it on. And you guys thought I never would, didn't you? I know you. All right, so thumbs up. Okay, so let's say that there's 2,000 of inventory that gets put in there. What that's going to do is overstate your inventory, obviously. Sure that I do that. So if this was actually, put in there erroneously to say 10,000, back to 17. Now instead of 11,000 that they showed, they're now making 13,000 on the sale. So anything that's in the inventory that shouldn't be there, the ending inventory, is a real problem. It overstates the inventory. It also overstates the income of the place. If you look at the balance sheet assets, the inventory will be too high. The equity section, the owner's retained earnings will be too high. It won't be equally too high. So anytime you have something that supposedly was, if the bill of lading that it wasn't shipped out until January 1st, could end up in that ending inventory and overstate your, and if they count that sale as a double whammy because they're counting the revenue coming in, but the inventory is still there, gets counted, gets taken off. And it makes the place look much more profitable. But also, this is also true for unmatched receiving reports. Unmatched receiving reports, they receive something, they don't match it up with anything, they don't put it on the books as a liability. There's no accounts payable for it. It's not matched up with either a purchase order or a vendor invoice. And it ends up here, and then it would overstate your inventory by whatever it is. Actually, the more I think about it, it would understate your liabilities. The bigger problem. Okay, what am I doing? Oh, don't do that. All right. Go back to All right, so what time is it? Okay, so let's go to the second page. The second page? Yeah, second page. Observe the physical taking inventory, make test counts, inspect the inventory to make sure it's in determine its existence and condition, making test counts. Okay, so we inspect the inventory. The auditor observes some obsolete inventory items. Which of the following assertions is the greatest concern? So we found some inventory that is obsolete. Which one of these assertions? Now, to some extent, you're going to have all of them, but which one is probably the most concern for you? If you find this inventory item and you realize it's obsolete, which one of these is going to be a problem? Which one?
Sharon.
Okay. I mean, to some extent, yeah, it will be, whether if it is saleable. When something is obsolete, what does that mean? What does that mean as far as the sale of it goes? What are you going to have to do to get rid of it? Anyone? Anyone playing along at home? Well, let's get the ones we already know. If you find it, that means it exists, so it can't be this one. We know it exists. You found it. It's actually going to be C. The valuation. Sorry, I didn't mean to do that. The valuation of it. Something that's obsolete has a lower value. So one of the, if it's not obsolete, it can be in with the rest of the inventory. But if you find something that is obsolete, whatever it is, oh, that goes along with this that they don't make anymore. That's here's a grill cover. Oh, for what kind of grill? Well, they haven't made those grills in 5 years. Oh, okay. The valuation of it is the problem. Does it have any value at all? Is a question. So finding obsolete inventory, it does exist because you found it, but the valuation of it's now going to come into question. What do you value that at? And this is all stuff that should be um, separated from the regular inventory. Observe compliance with management's instructions. We're not going to go too far into the stuff. Find evidence that the reliability of the count procedures. Okay, so this is how much reliability is there in the counting procedures? Why is it highlighting that? Oh, I need a question mark. Which of the following will usually be the best evidence about the reliability of the count procedures? Okay, so we're worried that they're actually the actual counting of the items is a problem. Which one of these things are we going to probably do to alleviate that concern we have? Huh?
So right, yes, that's fine.
This one?
Yeah.
Oh, uh, Yeah, observe compliance with management's instructions, taking inventory. That's you're gonna watch, they'll have they'll have printed up instructions as far as taking inventory. Sometimes they're standardized, sometimes they're ad hoc. But yeah, the compliance that they're actually doing what they're supposed to be doing on the list. There'll be, certain people will be doing things. For instance, one of the things that's always there is accounting. Almost always you'll have accounting departments observing the taking of inventory. You may have internal audit observing it. You may have, and often, if not all the time, you'll have the external auditors observing it. It's kind of funny. You have, and then you also have the operations observing it. So, you have four different groups observing the same inventory. Uh, so C, the reliability. Which one would maybe relates to the reliability of it? Which one do you think you would do to see if the counting procedures are actually being followed? And this one's a little bit tricky. Anyone? So I want to know if they're actually, if they're actually counting the inventory correctly. I mean, you got to realize too, because you're taking inventory, they wouldn't care if the place burned down. Actually, I do know of a case where someone did burn down the place, so they didn't have to take the inventory. It was a young one of the vice president's kids did it. But anyway, so you got, how are you going to ensure that they're actually counting the inventory? Which one of those things that are offered there would you actually look at?
Is it C?
Yes. Yep. C. And some people will say, well, we look at the completed count sheets. Well, the count, they'll turn in a count sheets. What you're trying to figure out is, did they actually do the count? They'll put a number in, but the question is it actually a number that they actually came up with? So you'll actually observe them doing it. And if you look at all of these, this is the one that's your own observations, your own things that you come up with yourself are more persuasive also. So not only will the observation tell you, or hopefully tell you whether they're actually doing the counting or not, but this is the auditor's own work is more persuasive. It's more persuasive. My wife was an English professor. She she cringes at stuff like this. There we go. There we go. Okay. Yay. Isn't this fun watching me learn how to use a computer? That's what you go to school for. Okay. Observe the control of the inventory tags and count sheets. So all these inventory tags are put on all of these things that need to be inventoried. And so the kind of, so what will happen is Making this up. So this is like, inventory sheet. So I'll go through and I'll say, okay, there's, and this will be tag number, 421. So here's tag 421. I go through and I count it. I take this tag, again, these are numbered, and I turn this in. Okay, here's what was on, rack 431. And it'll have that in there. Now I take that tag off that rack. Why don't I leave it on the rack? Okay, I did the inventory. Why don't I just set it right back on the rack? Because it might not be clear that that inventory has already been taken. So by taking this tag, I'm saying, okay, I did this. This tag is, this is completed. And somebody walking by and not seeing a tag on there will have the assumption that that is completed. Now, you will sometimes check the floor to make sure one didn't fall on the floor or something like that, but the tags themselves will be turned in to make sure that that inventory is counted. And so how do you know it's been counted? The tag numbers. You're going to sequentially look for the tags. If we had tag number 168 to 502, we're going to account for every one of those. And if we don't have one, we're going to go look for it. Where was it? Where's it supposed to be? Who has it? Did it get thrown out or by accident or something? So you'll go and find it. So that's how you make sure that everything was counted. By turning the tags in, you're ensuring that it was only counted once. So it does two things. It makes sure everything's counted and that it's only counted once. Let's go back to our. So, which defines the purpose of the inventory count tags? There's two of them. Anyone? Oh, come on. You get it. All right, I'll give it to you here. Everything is counted once. It's counted only once. We don't count things multiple times. Well, we just have someone out there and count it again. No, you don't. You count it once and only once. And by the way, counting the inventory is, while you do look for things that are obsolete and things like that, the actual valuation is usually done separately. Again, if something's obsolete or defective or broken or whatever, that is kept separately and maybe done separately, the valuation of those. But most of your run-of-the-mill inventory, Walmart has 50 million Snicker bars. You don't do those individually. You'll do test counts of those, but then those test counts will be matched up with the cost. Okay, let's stop here. Take a break. Let's say be back at. Why, it is late today. I talk too much. Okay, let's go ahead and get started. Gotta check over here. All right, never mind. We'll go ahead and see how far we get on this one. Okay, so you're also gonna get what they did for the inventory. You're gonna test, make sure they have the test counts are accurate and all that kind of stuff. Evaluate the basis and method of inventory pricing. So basis and methods. Basis is usually like something like LIFO, FIFO, that kind of thing. Methods could be perpetual, periodic, that kind of pricing. Those are all kind of things you had like in your, like in an undergraduate accounting class. Your first accounting class, they have like LIFO, FIFO, and all that stuff. Matching up the pricing of the inventories with the amounts that they are actually shown, making sure that they match up to what they're supposed to be matched up to as far as like the invoices, vendor invoices and things like that. All right, analytical procedures. I think I talked about this, maybe I didn't. Did we talk about analytical procedures? Analytical procedures are actually very important. They're required. Every audit's required to do analytical procedures. Analytical procedures look for relationships between numbers. Actually, let's just do this one and then it'll make more sense, I think. Okay, suppose we have this situation. So we have the 2005 numbers and, excuse me, 2025 numbers and 2026 numbers. What is unusual about these?
More sales, lower cost of goods sold.
Yeah, it's not usually the way it happens. The sales went up by whatever, 5 million. And the cost of goods sold went down by 2. Usually the cost of goods sold, you're selling more things, the cost of goods sold will go up. You sold more things. Now, is this evidence of fraud? Are you gonna call the cops? No. But it does point you in the direction of what, of where there might be possible misstatements, material misstatements. So analytical procedures by themselves usually don't indicate fraud or material misstatement, maybe is a better way to say it. By themselves, they don't, but they point you where to look. So analytical procedures would be comparing these two. Analytical procedures could be ratios, ratios of inventory to accounts payable or whatever ratios you come up with. But you're basically looking for plausible relationships. Let me write that. I know, I'll make it in big, obnoxious capital letters. Ah, you're looking for plausible relationships. So sales go up, you'd expect cost of goods sold to go up. That's plausible. When it doesn't happen like that, then you start questioning, okay, why isn't it happening? It could just be they're more efficient. That certainly is a possibility. But if you're looking at what to be possible misstatements, what would you look at on these two? What would you be concerned about? So you see this, you gotta say, man, that's unusual. Sales go up by, what would you be worried about? I'm not looking for specific, testing or anything like that, but just looking at the numbers, what would you be concerned about as far as the numbers are concerned?
Might have over.
Yeah, one of the things is, well, maybe this sales number is way too high. Only 34,000 cost of goods sold, maybe this number is way too high for some reason. So it could be that it's overstated sales. Oops, still obnoxious capital letters. So you certainly go and look and see if there's anything different about how they're recording sales, maybe when they're recording them, that sort of thing. What could also be a possibility here? Actually, it's still on the board. Oh, I moved up the camera, so they can't see it again. Um, Could be that cost of goods sold is understated. So there's a few different ways that it could happen. One of them could be that the ending inventory is overstated. Well, but regardless of how it comes about, the cost of goods sold might be understated. Whether it really is or not, or how it came about is more in depth than we can do here. But so those are the two things you'd look at. Now, these analytical procedures, they're required. We might make this down. So understated cost of goods sold, it could be overstating in the inventory. Yeah, it's right there. Oops. And it's one of those things you just kind of throw out. What could be causing this? The only reason why I'm putting that on there is that we just talked about. Okay, so analytical procedures. Why these are so important is that they are responsible for finding something like 95+% of fraud. They're not evidence themselves of fraud, but what they do is they tell the auditor, hey, look here, because this looks unusual. So analytical procedures, they find something like, depending on who you listen to, 95% of fraud. And I say identified because they don't actually prove it themselves, but they point you in the direction to look. You go look, and then you find it. And one of the things about the great thing about the double entry system, which I know is like 400 years old, and we kind of take it for granted, is that it's very difficult to have fraud in one area that doesn't affect another. So oftentimes, you look at the income statement, for instance, well, let's take this, ending inventory. Inventory is on the balance sheet. It's not on the income statement. Well, it's not on, it's not an account on there. But it might highlight that you need to look at that just from looking at the income statement. It might say, okay, look at the inventory, and maybe that's what will find it. So these analytical procedures are very important, and they are important at identifying inventory, not proving it, but identifying it. Okay. Go ahead and get the, okay, so let's take a look here. Pledged inventories. Sometimes inventory is pledged to a bank for funding. Under certain agreements, they will have the bank will actually have control of the inventory, and that the company will have to ask if they can sell it because the bank doesn't want them to sell it, taking losses on it and not be able to pay their loan back. So sometimes the bank will actually take over oversee the actual sale of the inventory. But anyway, if it's pledged for for some whatever reason. Okay. Financial statement presentation of inventory. And cost of goods sold. You must include the methods. Why is it do? Oh, let's make it capitalized. Any changes in the methods? For instance, you're going from LIFO to FIFO or something like that. By the way, can you do that? Can you change your inventory method from LIFO to FIFO?
I think if you want to do it,
Yeah. First of all, you're gonna separate the changes out because your financial statements might be a little bit different because of it. So you'll say, oh, by the way, this increase in cost of goods sold and decrease in inventory is due to the change in methods. So you'll definitely state that in there. But also, if you generally want to justify it as far as what the reason for doing it, usually. And I can tell you, like, for instance, one thing about inventory, the new LIFO, last in, first out, used to be very popular, is now starting to decrease considerably because international standards don't allow it. And so, you got really, so if you're using, say you're using international standards but part of the audit is in the United States, there's a problem with that. That you have an accounting method that is allowed in the United States that is not allowed on the international standards. And so you end up with this kind of strange reconciliation that goes on between those two. So it used to be a lot more common than it is now. I think it's down to like 10% or something like that. So anyway. Okay. I think we talked about this. Maybe we did. Wait, I don't think we did. How about floor to book and book to floor? Testing. I'll think about your stunned silence that we did not. One of the things with both inventory and for property, plant, and equipment that we'll get to is you'll do what they call floor to book. You'll go find something on the floor, you'll find inventory on the floor, and then trace it and make sure that it's on the books. In other words, it's in the accounting system. So I'll go find a lawnmower on the floor, and I'll go trace that to make sure that it's on the book. In other words, it appears in the general ledger and the financial statements and all that kind of stuff. So I'll go from the floor to the book. You'll also go in the opposite direction. Take something that's on the books and go find it. Okay. So if you go floor to book, you find something on the floor, whatever it is. I find a lawnmower, that they're selling a lawnmower, and I want to make sure that lawnmower is actually on the books. Which of these assertions am I most likely looking at? I want to make sure that lawnmower is actually on the books. Now, let's take what it's not. It's not going to be existence. We know it exists. We wouldn't found it. So it's not going to be existence. So we can knock that one out. We know, so I find this lawnmower on the floor, but I'm going to see if it's on the books. Is it cold in here? I'm a big fat guy. I'm cold. All right. So what? Any guesses or any ideas on which one of those would be?
I think the floor to book is to make sure for the completeness, but the book to floor is to make sure the existence.
You are absolutely right. And everybody should thank you because you've saved. We are earlier. Yep. So floor to book makes sure that the book is complete. Is everything on there? Is the lawnmower on there like it's supposed to be? You go floor to book to see, okay, if they have a lawnmower on their books, let's go find that lawnmower. Does it actually exist? When I was auditing, I think I told you, the when I was working for Navistar, we had an engine plant down in Indianapolis, and we made diesel engines for Ford. Almost all the Ford diesel engines, I don't know if they still do, but they used to come out of that plant. But they would have other, so maybe like 95% of the engines would go to Ford, and then the other 5% we'd sell to other people. Anyway, I saw an engine on the books for something like 20-some thousand dollars. Now, the normal run-of-the-mill engines back in the day were something like $3,000 or $4,000. So I wanted to see this $20,000 engine. I couldn't find it anywhere. I'm looking all over. I couldn't find him. Talking to people, they have no idea what I'm talking about. I'm showing them the thing, and they're like, "Well, I don't know what that is," and anything else. And just completely, almost by dumb luck, I ran into a guy and I was talking to him about it, an engine. And he talked about how he does testing on engines. I said, "Oh, but this one." He said, "Oh yeah." He said, "Yeah, we got that one. Yeah, it was a test engine, and they had it. I know they had it spec'd out to the millionth of a whatever, and they're running it for days at a time to see how well it works and all that. But anyway, it was a specially made test engine that they had, um, and he actually tried to show it to me, but if you look through this little window and you just see like an engine, there's all this stuff piled on top of it. You couldn't tell what it was. It wasn't as cool as I thought it was going to be. Okay, let's go to property plant equipment. Okay, property plant equipment. Audit time spent verifying $10 million of property, plant, and equipment versus $10 million of inventory. Which one do you think is going to take more time? Let me write that. Which one's going to take more time, the property, plant, equipment, or the inventory? Most likely. Anyone? Which one? The inventory is going to take more time. Yeah. Yeah, $10 million. Think about like Walmart. $10 million. You can imagine going through how much stuff you'd have to look at to get $10 million of inventory from Walmart. And yet, if it's private plant equipment, that might be one store. There's the building, found it. Is it on the books? Yep. So, inventory would take a lot more time. And that would usually take more time. It's actually more at risk. Who's going to steal a building? Nobody. Well, I guess you could, deed fraud or whatever. But anyway, so inventory is usually going to take more time to do, and it has to do with the property plant equipment generally is much bigger stuff, and it's not nearly as mobile. You don't have to worry about someone stealing a robot out of a assembly plant in Dearborn, Michigan. And someone stealing car tires out of there, that's probably much more, likely. Okay, initial audits of property plant equipment. Usually the first year, there will be a complete audit of, oops. Let me change that. So the first year, the initial audit will usually require a complete audit of property plant equipment. And kind of regardless of whether they had one last year or the year before, whatever, if you're taking the audit on for your first time, you're probably gonna want to get familiar with all the stuff that they have, and you'll do a complete inventory of property plant equipment. Subsequent audits of property plant equipment. Usually in following years, you'll simply look at additions and retirements. And maybe every 3 to 5 years, you will do the complete audit. Hmm. The complete audit will be performed every 3 to 5 years. And interim interim audits will verify additions and retirements. So, okay, maybe you do it every 5 years. So every year you go and say, okay, this is what it was. Let's verify the additions and the retirements to the property, plant, and equipment. What did they buy? What did they get rid of? So initial audit, you do the whole thing, then usually put them on a 3 to 5 year cycle, depending on their controls and what kind of business they're in. And you're only going to look at what did they add and what did they get rid of. So you're not going to do a property plan and Okay. So the changes, but these are the changes we were talking about. Oops. So you're going to reconcile the additions and retirements to the general ledger. Okay, vouch the additions. Vouch is the actual payments or however you want to describe you that you were able to obtain these during the year. You do physical, so this is what you the actual payments to the for these items. And you're going to look to make sure that that everything that is included should be, and that there isn't anything in there that shouldn't be included. There's rules on basically what you would actually record as the property, plant, and equipment. Make a physical inspection of property, plant, and equipment. I had a weird one with this. Um, Visions of property, plant, and equipment exist and are in use. If they're not in use, they don't go in property, plant, and equipment. Now, your question is, where do they go? It depends. If it's something like land, it'll go in investments. If it's something like a piece of equipment that you are going to use, but you aren't using it yet, it will not be depreciated. So if they're depreciating it and it's not in use, they gotta back that out. But it should either go with the other assets or with investments, depending on what it is. The land virtually always goes with investments. Okay, this is a big one. Analyze repair and maintenance expense accounts. WorldCom comes to mind. You want to make sure that repair and maintenance is not charged to new equipment. And conversely, repair and maintenance for major upgrades should be charged to property, plant, and equipment. Let me write that down. Should not be capitalized. This goes to the WorldCom, the WorldCom fraud. WorldCom was a cellular phone company, and actually, so here's what happened. The Enron case hit, like 20, I think it really came to that, like late 20, when was that? I don't remember. 2000 something. Anyway, around 2000, it came to, and people were all upset about it. They couldn't believe it. You know, there's $1 billion fraud. And then it kind of settled down for about a year. And then the WorldCom case hit. And the WorldCom case was actually even bigger than um, the Enron case. And so that triggered the Sarbanes-Oxley Act. I don't know if you guys know this or not, the Sarbanes-Oxley Act was around for years. They could never get it passed because companies all squashed it. Well, no one was believing the financial statements. So businesses actually begged to have something put on the books, and so they said, "Oh, we get the Sarbanes-Oxley, yeah, do that." So that's how they got the Sarbanes-Oxley Act to pass. It never would have passed without Enron or WorldCom. But WorldCom was this: they would take their maintenance expense. I guess these towers and stuff take a ton of maintenance. Bless you. And they were saying it was new equipment, and they hid about $2 billion doing that. Saying that it was new equipment. And so they should not be capitalized public plant equipment. However, you also look at repair and maintenance for the other end of it, and that is major repairs that increase the capacity or the life of an asset should be capitalized. So if you have regular maintenance on a truck, that's just maintenance expense, new tires, brakes, whatever. If you overhaul the truck and add 5 more years onto the life, that should be capitalized. So you're going to go through those expense, maintenance expense, and see, not only not only are the additions, are they actually there, that should be repair and maintenance, but also look at repair and maintenance and see what, if any of those should be capitalized. And sometimes the companies don't like to capitalize things because it makes them look, bloated. If you have a ton of assets, and a little bit of income, it makes you look like you're not very run very efficiently. So a lot of times they don't like having the liabilities on the books, but they really don't like having the assets on the books either. So sometimes there'll be companies that will be trying to avoid that. Investigate the status of property, plant, and equipment not being used. That basically is, where does it go? It's not being used, should not be in property, plant, and equipment. What are you talking about? When was it? Oh boy. Which one do we have? Oh. Okay. Someone says property planning, but let's see. We'll cover a couple more of these. Right. And what I'll probably end up doing is maybe next week we'll finish this, and then get started on the sampling. The sampling's not going to be too difficult, but we'll finish this up. We'll probably finish this up next week. We'll do one more question here because this one will take about 30 seconds, and then we'll call it a night. Okay. I really thought I was going to get through this one. I cut it way down, believe it or not. Test the client's provision for depreciation. This is really done by the auditor's recalculation. using the client's methods. I should say the client's stated methods. So, and by the way, this is also one of those things that is more persuasive when you do the recalculation of their depreciation. So if they say they're doing it under, whatever, double declining balance, when you actually do the recalculations, you'll be using their methods and seeing if they are. You're still looking for if it's materially misstated. It doesn't have you right down to the penny, but it also is. It's important you recalculate it to see that their provisions are correct for it, and there's often a discrepancy between the tax depreciation and the depreciation the company uses. Tax depreciation is usually more aggressive. They depreciate things much quicker. You may have a piece of equipment that is going to last for 8 years, but the IRS says, no, that's 3-year depreciation. And they do that to encourage people to buy more equipment because you can write more of it off earlier. But they're not really looking at the income. They're looking at encouraging people to buy more equipment. Why? They want people to buy more equipment. Well, it keeps companies going, keeps the economy going. There's all kinds of reasons why they want you to buy equipment. But it has nothing to do with your actual income. And so you have to check those depreciation methods because those will also go into the taxes, the reconciliations with the taxes, and you will have tax liabilities and tax assets that come out of them. Let's stop here. I'm not going to finish this, so I'm just going to pout about it. Oops. I can't even really stop. See, I'm so upset. All right, so I think the accounts receivable exam is due tomorrow. And that was, hey. Where is it? Oh, my screen, it's all shrinky. Here we go. I just want to check and make sure. So if you haven't done it already, make sure you get that in tomorrow. One more thing I want to tell you guys too is that just because something is past due does not mean you can't turn it in. You get full credit turning it in. Yeah, the Chapter 11 exam is due tomorrow. So go ahead and make sure you get that in. But oh, where's my one thing let me put it here so it's in writing. Assignments and exams we turned in late, not late for full credit. I don't think anything off as long as it's during the it's got to be turned in during the term. Now your grade's going to look bad until you turn it in, but you can't. So don't think, oh, I didn't turn it in. It's due Friday. I didn't get it in. I can't turn it in. Yes, you can, and you'll get full credit for it. Your grade's going to look bad until you do turn it in, and all this stuff is recorded, so you can actually look at the videos and usually fill those out. And other exams, you can still work on those. So if you can't get the exam in, there's nothing wrong with taking a couple extra days or something to get it in, but just make sure you do get it in by the end of the term because obviously it has to be in by then. Okay. Any questions? I'm going to hold off. Don't turn any of this in. We'll finish this next week. Next week we'll turn this in, and we'll also be able to finish the sampling handout. So don't turn anything in tonight. Well, yeah, no, don't turn it in. Are you with me? Okay, so any questions?
No.
Look how big my melon head is. All right, I will you guys next week, and you in here, I'll check those off.